Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Myles Udland this morning. Let's get to the three things that you need to know today. First up, U.S. stock futures in the red this morning as disappointing earnings and economic concerns weigh on investor sentiment. Traders are bracing for headwinds from President Trump's policies ahead of an April 2nd deadline for a series of broad reciprocal tariffs. However, investors haven't entirely given up on stocks. Equity funds saw their largest weekly inflows this year on a view that the trade war won't derail the economy or the stock market, according to Bank of America.
Plus, Nike and FedEx shares falling this morning as the companies warn on tariffs and the state of the global economy. Nike signaling further declines in revenue and profitability as the company tries to clear out old inventory while feeling the effects of the growing trade war. Stock here off about 7%. Meanwhile, FedEx shares down about 9%. That company lowering its profit guidance for a third straight quarter as inflation and uncertain demand for shipments squeeze the parcel company's bottom line.
And global travel facing a massive disruption here. A fire near London Heathrow, one of the world's busiest airports, caused an unprecedented power outage impacting hundreds of thousands of individuals, with over 1,300 flights to be canceled or rerouted on Friday alone. This is the worst disruption for the airport in at least 2 decades and is likely to raise questions about the robustness of Heathrow's infrastructure and why an airport of such scale and importance had no redundancy systems to keep operations going. One of the world's busiest airports has shut down after a massive fire caused a power outage at London Heathrow. There you're seeing some of the footage as tens of thousands of passengers have already been impacted and 290,000 people who were scheduled to fly to or from the airport will be affected, according to data from Cirium. Now, on average, London Heathrow Airport handles about 1,300 flights per day and sees an average of 229,000 passengers travel through the airport on a typical day. The airport will be closed all day today as they work to restore power, and counterterrorism police are investigating the blaze, which has left thousands of people stranded in the UK and abroad. British Airways, which is owned by parent company International Airlines Group, was the worst affected with 265 flights canceled, about 37% of its schedule, according to flight tracker FlightAware. Meanwhile, U.S. airline stocks were not immediately impacted by the outage, as flights to the UK make up a small percentage of their total volume. U.S. stocks are poised to open the day lower, but the S&P 500 is up slightly this week. This is following 4 weeks of losses. Meanwhile, a new note from Bank of America shows, despite investor concerns over slowing growth and tariffs, stocks and funds, they saw their biggest inflows this year. Joining us now to discuss this a little bit more, we've got markets reporter Josh Schaefer here. What have you been able to dig through here and extrapolate?
Yeah, Brad, so I guess just making sense of that flows headline to me would sort of be, let's talk about the longer term story first, right? And I think a lot of strategists we speak with still feel pretty confident in that longer term story, right? They still feel confident in the overall trajectory of earnings growth for this year. We've decided that U.S. economic growth might be slower this year, but we've sort of walked back the recession talk. I think there was like a quick moment where everyone was like, all right, how bad is this? And we've decided not that bad from an economic perspective. But then I think you look at sort of the short term and what you talked about there with basically a week where the index hasn't really moved that much. And I don't know if the short-term story has really changed that much overall for stocks this week.
I mean, look, futures are down this morning, and the president is out this morning talking once again about we have additional tariffs coming on April 2nd, which is what he has said, and he continues to reiterate that view. And I think it's interesting, Josh, to see those inflows to the market where we have this battleground right now in the state of the economy. As you mentioned, there's this, you can look at plenty of data that is not concerning really in any way, shape, or form when it comes to the health of the U.S. economy. But the concern for investors is the trade war. And this whole notion that Trump was to be taken seriously, not literally, on the trade war, that has gone away. He is to be taken literally and seriously on this. And I think seeing the market once again on this Friday morning, reacting to another post from Trump on Truth Social, reiterating that tariffs are coming, continues to show, despite those inflows, I think the perilous state of this market and what is the marginal driver of investor sentiment at this point.
And it's interesting, too, you point to the market today, and we actually have stocks lower that are definitely going to be impacted by tariffs, right? Two companies talking about it last night in Nike and FedEx. And an interesting comment that a strategist was making the other day is we've been talking about tariffs being the leader of this correction in the S&P 500, right? Started with political uncertainty. That's sort of what drove our valuation re-rating. But when we think about what's really down over the last month, a lot of it is large cap tech. And you could make a nuanced argument there that large cap tech would not be the first area I would circle that's super exposed to tariffs. Yep. Essentially arguing if we do get a lot of tariffs and more tariffs than we expect on April 2nd, are we priced for that at this point? Or is there a lot more selling that needs to happen in other areas of the market outside of tech that haven't really come down as much at this point?
Well, I guess what does that lead to in terms of the dip FOMO for some of the investors out there that are saying, okay, clearly this pullback presents some type of opportunity. I just don't know where the viable opportunity is for some of the larger rebound to really take effect when and if it does.
Yeah, I mean, Brad, it's been interesting. I've been asking people this question pretty much all week, essentially just pulling up a 52-week high board of the NASDAQ 100 and saying everything's down 20%. What do we like here, right? And I think you are hearing some people start to talk about some of these larger cap names. We had one strategist the other day say, I still like Amazon, liked Amazon before, now we're 20% off the highs. What's been interesting to me, haven't heard a lot of people say they love Nvidia here. We were talking to an analyst yesterday who said, it's 120 bucks a share. I think it's maybe a $125 stock. And so you're not really seeing people come and hammer the table for Nvidia, which has been different than what we've seen over the last 2 years, right? Normally you see the big Nvidia drawdown and the buyers come in.
And I mean, there's a few threads here. On the Nvidia point, which we've discussed at length in the newsroom, what am I going to say? I'm going to say the stock's gone nowhere in 9 months. That's the problem. People did not buy Nvidia over the last 9 months with the view that this would be a GDP plus grower. Right? They bought it because they thought the stock was going to double. So there's that part of it, retail bid, all these kinds of things. But this, the Nike and the FedEx stories this morning bring me back to the Delta news from, what was that, Tuesday of last week? It was after the close, Tuesday, Wednesday, something like that. And it's going to be this trickle of companies that come out. And while you have, on the one hand, the headline of, the president says this, that's not great for my view that maybe tariffs would go away, you're going to start to really get this trickle of companies that say, and here's the material impact to our business or the challenges that we're having in terms of forecasting this. And it really goes back, Josh, to that question of people say there are things that look attractive. I'm just not sure what that's going to be other than say, let's just de-risk in general. Let's just take the portfolio down. Whether that's build up cash, buy bonds, you can do all kinds of things. Does it have to be stocks after 2 years where the S&P was up 20%?
And to your point, Myles, I think that sort of is a helpful guide to what our timeline is that we're talking about here, right? We keep talking about April 2nd, we're going to learn more about tariffs. First of all, we might just not learn more about tariffs, right? We don't really know what we're getting then, but really first quarter earnings season will start, I think, about a week later. And then it's going to be that month-long period into really the middle of May where we hear what do the companies actually say about these tariffs, and that feels like, so we're probably in this choppy, volatile period for perhaps a little bit longer.
Right, while at the same time trying to get their own exemptions wherever possible, too.
Of course. Everyone wants an exemption, Brad. Why not?
I mean, why not?
I want one.
Josh, thanks for taking the time this morning. Well, Nvidia GTC failing to revive the beaten down tech trade, which is seeing its worst start to the year in the past 2 years. With recession risks growing and the Fed planning for just 2 rate cuts through the rest of the year, how should investors navigate the tech trade? Joining us now with more on this, we've got Sylvia Jablonski, Defiance ETFs CEO and CIO. Great to speak with you here this morning, Sylvia. So just take us into your best assessment of the land right now, because you do have this pullback that we've seen in tech. Some of those names, of course, have been the major outliers in terms of the market leadership for the past 2 years with the 20% gains in compound that we've seen essentially. And so now that we've seen this pullback, what is the best estimation as to how traders should be reallocating some of their positions?
Good morning. Well, yeah, I mean, we've certainly seen the pullback in the Mag 7, and I just kind of heard the last conversation there about nobody's pounding the table on Nvidia, and I mean, I will pound the table on AI and quantum computing, right? That next generation of technology, and then through that, I have to pound the table on Nvidia. I really think that you're talking about these transformational shifts that are going to change the way we live, work, play. Interact with data, benefit health systems and things like this. And these stocks that are beaten down are going to be, the key players in those trends. And so what I would say is right now, when the market is like this, investors get spooked. And what they do is they allocate to XMAG. They look at, the other 493 stocks. They look at ETFs that, kind of like take out the Mag 7, or they just allocate to the single names that are outside of the Mag 7, or they go to the sidelines, right? But I think, if you look back at 2022, if you look back at COVID, it's, of course, the generals always fall first, but then, if you buy them on the dip, they're also the ones that tend to recover first and give that performance back pretty quickly. So I think if you're in it for the long term, there's some good dip buying here.
So Sylvia, maybe pulling away from the stock performance for a second and just some of the details that we heard on the technology front, the product side at GTC. What were your kind of takeaways as you look through, really 3 very busy days for the development of AI, quantum computing, and so many things that are really going to shape tech over the next couple of decades?
Right. So what I took away from it is that there is so much enthusiasm for the continued growth of AI, and for the kind of commencement of growth for quantum. You had that ChatGPT moment, which I think propelled AI forward, and you had a lot of market spirits just driving a lot of these stocks up before anything really happened. And then, of course, it kind of falls back. A lot of people call it a bubble. I think what has happened since is that there's now this reset, and now there's more information about how these things work, right? Like now we have ChatGPT, we have Grok, we have these different tools, and, we're seeing the benefit of them, and corporations are seeing the benefit of them. So I think what was exciting is that you can kind of start to see how AI is going to replace a whole lot of costly types of processes over time, and benefit the revenues of, the greatest companies in America and their future earnings potential, and then GDP. And then with quantum computing, there's kind of been this uncertainty around where are we with this? And when you hear from companies like D-Wave who are doing it now, IonQ that has a strong balance sheet and has come up with this, ion trap technology, Rigetti, I think there's a lot of exciting opportunities here, again, for longer term investors that are of the belief that we're at the beginning of this, transcendental type of technological change.
Just to follow on that, like I know what I can do with ChatGPT right now from a consumer perspective, and companies probably know what they can do with generative AI from a data set perspective. I have no idea what I'm going to do with quantum, what use it would have in my daily life, what use it would have for some of these companies. They're probably having a lot of different discussions with their own, KPMGs of the world or Accentures as they're having all these consulting meetings and trying to figure that out. But how fast can this realistically scale?
Well, I mean, if you think about it, the theory is that you have a classic computer and it operates in zeros and ones, and then you have quantum computing, which can, operate in multi-states, in parallel states, and it's thought to do things, 1,000 times quicker than what a classic computer can do. So if you think about well, what do you need that for? I mean, driverless cars, right? You would have to process data at these immensely quick speeds in order for that to be effective, and robo-taxis and things like that. Same thing with cryptography and aerospace and defense, even bank risk and things like that, making real-time decisions about who to give a loan to, or kind of like what to invest in and whatnot. And you might think you have that with AI. You have it, but it's still really, really slow. If you talk to any doctor that does research, for example, it takes them hours and hours and hours to parse through data to come up with one potential thesis, and then months and months to sort that out. If quantum computing is accurate and parses that data more quickly for them, does that cut drug discovery, cure discovery, things like that, in half or more? So I think it'll impact, the society greatly in the future, but it's in its infancy.
Sylvia, before we let you go, I want to ask a little more broadly about what you're seeing in terms of investor behavior, in terms of flows, what the market feels like to you guys based on, what you're seeing on the ETF side, and where demand is really cropping up. Because, with this kind of market action, it's always been interesting to see how relentless, various ways you cut it up, that sort of retail, that buy the dip mentality has stuck around, even with, some of these majors really coming off in terms of price.
Right. Well, I can tell you just, from our experience as an ETF issuer, we've mostly seen inflows into our funds, right? So the price of the funds is going down because, particularly with like quantum and 6G and things like that, because big tech is going down, and that's impacting anything related to tech, semiconductors, things like that. But actually the flows are coming in, and particularly into quantum and particularly into 6G technologies, right? And I think a lot of that is around this this conference and Nvidia's announcement that they're going to be investing in quantum, that they're going to be building out 6G because you're going to need this lower latency for all of this data to be sort of processed and for AI to come to fruition to its best capacity. And so we actually are seeing a lot of flows into these types of names. That being said, on the other side, we're seeing large institutions that had a heavy overweight to the tech names. We haven't seen them selling, but we've seen them allocating to XMAG. So they're actually taking on more market exposure because there is this dip and opportunity to buy, but they're looking XMAG right now. So we're definitely seeing that on the institutional side.
Sylvia, good to see you. Thanks so much for the conversation here this morning. Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, we dig into FedEx earnings and what it says about the health of the economy. And Tesla CEO Elon Musk telling employees to hold on to shares. We bring you those details next on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Tesla and CEO Elon Musk looking to reassure employees at an all-hands meeting, asking Tesla employees to hang on to the stock despite its recent plunge. Take a listen.
So it's very difficult for people in the stock market, especially those that look in the rearview mirror, which is most people, to imagine a future where suddenly a 10 million vehicle fleet has 5 to 10 times the usefulness. So what I'm saying is hang on to your stock.
Musk also reiterated his claim that Tesla will soon be capable of driving autonomously here. As we were taking a look at shares on the day, fractionally pre-market, we were seeing some declines here. One of the huge things that insiders reporting as well, this was a surprise for a lot of employees. So an unexpected and impromptu town hall where Elon Musk took the stage. There were no seats. If they zoom out, you could see people just kind of like standing and clapping and cheering.
Well, yesterday, if you'll recall, I believe it was Wednesday night, Dan Ives, our friend over at Wedbush, came out with a note, and I think he's the most influential Tesla analyst on the street right now, comes out with a note and basically says Elon needs to show his commitment to Tesla. He needs to show up and do a meeting like this, and then 24 hours later, Elon is standing there holding an all-hands meeting with everyone at Tesla. And I think part of the stock, the stock story, which has been complicated over many years, has had many 50% drawdowns or more over the years. I don't think longtime Tesla bulls are too concerned about the 50% drawdown we've seen, but the experience over the last 3 months has been unique in that Elon has had a lot of other things going on.
Right.
And there comes a point, and I think, Ives is among some on the street, but again, in my view, the most influential, who said, okay, you need to come out and reassure investors, reassure your team that you are fully engaged with what's happening at Tesla. Not to say he hasn't been, but he needs to publicly, in a forum like this, come out and do that. And, sure, the stock is down a little bit this morning. We're seeing selling pressure across the board. And does this make the stock double from here, get back to all-time highs? I don't know if it's enough. I don't know if one town hall is enough, but it's the beginning of, I think, Elon very clearly re-engaging or signaling that he has remained engaged with the process at Tesla. Again, something that investors have been calling for.
Yeah, and not doing it in this case with a black on dark gray lettering MAGA hat. So in this instance...
Yeah, you know what? That's not insignificant. You're right.
Right.
You're right.
Because
I didn't even think about that.
At many other forums, it's just like, okay, I'm going full gung-ho in that direction. One of the things that he also mentioned, too, for the investors out there, Optimus. He talked about this potentially being the biggest product ever. Thinks about the mission statement of the company, and it's evolved to be a sustainable transportation and then sustainable energy company. And he says it's going to evolve again, and we'll see what that evolution goes.
Yeah, I'm very curious to see if this is merely the beginning of more of these kinds of appearances and sort of what happens with the whole Doge experiment and sort of, as a result. All right, let's turn our attention now to shares of Micron. That stock was down more than 3% in pre-market trading and reversed initial gains from last night. That comes after what was a better than expected quarter from the chip maker, but this morning's move coming as markets overall selling off. And I think ultimately, Brad, reflecting some investor skittishness about the overall state of the AI trade. We're rounding out the first quarter here. We're heading into a very crucial second quarter earnings period. And I think ultimately any company at this point, we saw it with Nvidia not too long ago, only 3 weeks ago now, coming out and saying that, we are comfortable with where we're at. We're actually going to slightly raise our guidance. I think, their revenue range was, a couple $100 million above the top end of what the street had been looking for. But in this kind of environment, I think we talked to Sylvia Jablonski earlier about the selling pressure that you're seeing in these names. And despite the conviction that you have, whether it's with the optimist trade on the Tesla side, whether it's with the quantum trade and some of the things Nvidia is doing with its software and its next generation chips, it's very challenging to just go out and catch a bid from markets right now that are only looking, in my view, only looking for reasons to sell some of these names.
One of the best things that investors could probably do around a name like Micron or even AMD within that same regard here is when you see the transcript come out for some of these earnings calls, just do a Command F or a Control F if you're using a Microsoft operating system. Look for demand specifically within these reports because that's going to give you everything that you need to know essentially about the runway for the future, how much of that demand is pulled forward and how much of it still exists out there that is untapped in that total addressable market that all of the companies are talking about at this juncture too. 45 mentions of that word demand in this most recent.
I was going to say I think there's a transcript that has the prepared remarks and one that just has a Q&A.
Yes.
I had 21 in mind. So.
You're right. Take out the
Go
Q&A.
with that.
Yes, use the Udland gauge. Also here, we got to talk about FedEx. FedEx cutting its full year forecast amid concerns about the health of the economy. This is the third straight quarter that the company has lowered guidance, and FedEx is just the latest company sounding the alarm as consumer confidence weakens and the global trade war continuing to escalate, or at least getting to a point where it is so uncertain that they have to back out some of the guidance that they're offering here. And that's what caught my attention on the call here as they were talking about the weak industrial economy. They talked about navigating many headwinds, but added uncertainty to demand in light of the uncertain demand environment and higher than previously expected inflationary pressures on their cost base. They're lowering their fiscal year 2025 adjusted EPS outlook to $18. That's down by about the new range is $18 to $18.60 is the new EPS outlook for the year-to-date basis.
And now looking for revenue to fall. And I think the whole FedEx trade, very reminiscent to me of the trade war back in 2018 in this respect, because of where FedEx reports in the earnings calendar, it has almost always fallen on a week when there is a Fed press conference that is accompanied by a summary of economic projections. And I recall very well in December of 2018, Jay Powell comes out, whatever it was, the 17th of the month, let's say, it was the Wednesday, and he's like, we're fine with interest rates, market hates it. FedEx comes out the next night, says basically what they're saying today, market hated that even more. And here we are, 7 years later, 6.5 years later, and we're kind of doing the same thing. Powell comes out on Wednesday, market's like, yeah, okay, we can be okay with this.
Yeah.
It wasn't like amazing, we kind of sold into the close there, but they're okay with it. And now FedEx comes out and stock's down 10%, and everyone's like, oh, okay, this is the real story.
Yeah. Well, I think it's also an acknowledgement of how much the companies that FedEx works with are also passing so much of the costs, both on product and on shipping, straight onto the consumer here, and how much the consumer is going to be pushing back on that.
And you know what? And to go back to Powell, what did he try to say more than anything else on Wednesday? There might be an inflation shock, but it will be transitory. And maybe it will be. But FedEx is not really thrilled with that characterization.
And the street doesn't like that characterization.
The street doesn't like that either. And sure, maybe it's a one-time adjustment. Maybe it's a one-time change to EPS. Maybe that's a one-time sell in the stock. But when you come out and you say we have an uncertain inflationary environment, inflation, uncertain cost pressures, that's not the kind of thing that engenders a ton of confidence from the analyst investor community.
All right, they saw me flipping my paper over to my next set of notes on FedEx, but they said T's next, so
that's enough. We got the open coming.
Yeah, Myles, thanks for joining us this morning. Appreciate it. He'll be back later on this hour for Catalysts, and we've got all your market action straight ahead. Stay tuned. You're watching The Morning Brief. That's the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ, where you've got Smart Chem ringing the opening bell. You're blinding me with science, as Thomas Dolby would say. Yeah, press that button, get some funfetti as your reward. And at the New York Stock Exchange, you've got American Water ringing the opening bell. All right, let's take a look at the markets out of the gate here this morning. You've got the Dow and the S&P 500 moving to the downside by about 0.75% right now. We'll continue to track that. 0.8% roughly in decline for both of those major averages. The NASDAQ composite, that is calibrating to the downside to start off today's activity, lower by about 0.9%. Want to take a look at some of that sector activity here on the day as we begin the trading session. You're seeing all of the 11 S&P 500 sectors in negative territory right now. Color me surprised, but color it red, if you will, across the board. The Dow Jones Industrial Average, of course, we were tracking that in the red. Consumer discretionary, one of the leading sectors that's in the red as of right now to begin the session. That's down by about 1.25%. And I was hoping that we'd see potentially a bright spot as I was diving into that, but we don't have one. Taking a look at the Mag 7, you're seeing right across the board there as well. Sans Tesla, that's up right now by about 1.25%. Interesting, as we were seeing that name move to the downside in futures, but now catching a bit of a bid at the gate here this morning. And then taking a look at Apple, Nvidia, and Microsoft, seeing some fractional pullbacks there, as well as with Amazon and Alphabet. Another Mag 7 name has found its way into positive territory. That, just after the open, is Meta Platforms, up by about 0.2%. Lastly, before I toss it on over to Jared Blickery, who is standing by, let's take a look at the Dow Jones Industrials. Those 30 components here on the day, you've got just one bright spot, and that is Verizon. That's flat, just barely to the upside. We'll see if we can hold on to that. The worst of the decliners right now is the swoosh, formerly Blue Ribbon Sports, now Nike for the past several decades, basically. You're seeing that lower by about 7.5% to start off the day after reporting earnings yesterday. You saw a bit of a pop after the initial report dropped, and then after the call, that's when you started to see some of the slippage as analysts, investors wrap their minds a little bit more around what was disseminated both in data and some of the broader analysis and assessment of the environment for the company and the consumer that it services as well. We'll continue to track all of these names and much more. Procter & Gamble has found its way into the green as well, and J&J saying, hey, hold my beer, we can do that too. Let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving here. Jared?
Thank you. Blue Ribbon Sports, learn something new every day. I want to go back to the indices where we have stocks, that would be the S&P 500 and the NASDAQ, snapping 4-week losing streaks. And let me put a 5-day total on here so you can see, well, we're not seeing the positive action just there. Let's see if we can do it in the S&P 500. No. So basically that was the case yesterday, but it looks like we're going to extend that streak if we hold on to these, but things can change into the close. We only got 0.5%, and we have been seeing some rallies throughout the day, so anything can change into the close, but we'll keep that in mind. Here is the VIX. The VIX has climbed back over 20. It's just kind of one of those big psychological levels, but we did see a pop below that early yesterday, and it kind of sustained that way throughout the day, but we're back above, so stocks in a little bit of sell-off mode here. 10-year T-note yield, not seeing a lot happening with that. US dollar actually touched the highest price in 2 weeks, if only briefly, but to be fair, it really hasn't done much over the last few weeks. It's just been consolidating this big down movement that we saw at the beginning of the month. And for that matter, we've seen a lot of consolidation all over the place in the markets this week. And sometimes it's easy to get caught up in the day-to-day movements, but a lot of those movements have not been big. As Brad noted, everything in the red here sector-wise, we're looking at tech and consumer discretionary leading the way down. Industrials also in the mix, and materials down more than 1%. But I want to show you who's leading for the week. That would be energy. Energy is up 3.4%. And then I'll show you the year-to-date. Energy is up 8.4%, leading over healthcare. And just real quickly here on energy, I'm going to show you a 5-year chart. It has been basically doing nothing since the 2022 bear. It looked very promising, petered out about mid-year, and then it hasn't done anything since then except frustrate some traders. Here's a max chart just to show you that it has been at these levels before 2014, 2008, 2009. So energy is poised to make a breakthrough, but that could take months, maybe a year to develop. Here's consumer discretionary, the worst performer of the year. That's down 13.5%. That gives a good segue into our Mag 7, where Tesla was a big part of that story of consumer discretionary being weak, but not today. Tesla now up 1.77%. Meta also climbing in the green there. But for the most part, the Mag 7 stocks have been consolidating as well. I want to get over to futures where we have copper. That is coming back, that is pulling back a little bit, but it was almost at a record high. And I've been tracking this, basically the same headline for days now, nearing a record high. It looks like it is at a record based on this, but some intraday action earlier here suggests that it has maybe another % to go. Anyway, we'll be monitoring that if and when it finally does break out. But think about what that says about the demand picture around the globe. You throw some tariff uncertainty in there, it's an impressive market to watch. Finally, and here is Bitcoin. Bitcoin not doing a whole lot. It's been consolidating as well. I'll show you the year to date. It's just been hanging out at these lows, and it rejected 87,000 earlier today, and that's after rejecting 77,000 a few weeks ago. So if you're doing the math, that's about a $10,000 swing that we're seeing in Bitcoin. Doesn't really matter what happens until we break out of that. So 77 to 87 is our range that we got to break out of. And on that note, I'll send it back to you, Brad.
Jared, thanks so much. Teeing up today's trading activity. It's time now for today's strategy session as stocks are falling, as tariffs are top of mind for investors once again, and the Fed offering little comfort about their ability to grapple with the implications from President Trump's additional tariffs set for April 2nd. Chair Jay Powell bringing back the idea of transitory inflation, saying it could be the case for rising costs that come with these tariff policies. Joining us now, we've got Robert Socken, who is the senior global economist over at Citi. Good to see you here this morning, and thanks for joining us. So I believe exactly what he had said is that, as he had mentioned prior, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by them, if it's transitory. And of course, that is where the markets have a lot of PTSD, and perhaps economists even like yourself, Robert. So just take us into the thinking around how transitory some of the tariff impact to inflation could be, and the time span that would really be appropriate to consider that with.
Yeah, absolutely. And this is really the key set of issues that economists, markets, and the Fed is grappling with. That when you have tariffs, it's going to affect the growth side of the mandate by lowering growth and the inflation side of the mandate by boosting inflation. And those two things tell you to do different things with monetary policy. We think that even though you're going to get probably a similar drop down in growth this year as you are a boost to inflation, that is, we think the tariffs are going to lower U.S. growth by about 50 basis points this year relative to a no tariff baseline, and raise inflation by about 50 basis points as well. We think that the growth concerns are really going to dominate in the Fed's thinking. And if you get worse scenarios than that, you could see the Fed cut rates more than we're thinking and markets are thinking, and that really they are going to probably look through that inflation boost. Now, there are risks here. The risk, of course, is that even if inflation from tariffs is temporary, you could see that bleed into inflation expectations, and that is really when the Fed would start to get concerned about the inflationary effects. But at the end of the day, I think the growth effects are likely what are going to dominate their thinking. And so if you get substantial tariffs, you're likely to see the Fed lean into easier policy.
It sounds like you're in the camp that we could see a potential growth scare. Is that right?
Yeah, absolutely. I mean, right now, fairly constructive on the U.S. outlook because the data still, while noisy, look pretty good overall. We're still expecting growth kind of in the high 1% range for the U.S. this year. We were expecting growth closer to 2.3% before the tariff effects. But that being said, you are seeing a lot of noise in the data. You've already seen some of that in Q1. And if you were to get substantially more tariffs, you could get more of a growth scare later on, particularly as the economy starts to feel those effects and slows down a bit more genuinely. And if those tariffs start to really affect how much consumers and businesses are willing to spend, those secondary uncertainty effects, which we're potentially seeing a hint of in some of the survey data, which have softened in recent months, then you can really get those fears growing more and maybe even becoming self-fulfilling. So, while we're still constructive on the outlook, I do think recession risks have grown over the last several weeks.
To what extent does industrial production really come into play there? Because we did see a surprise to the upside, but in broader context, the outlook here on the manufacturing side as part of the industrial production, that certainly has had the looming cloud of tariffs over top of it that has been a consideration.
Yeah, absolutely. And I would make a few points there. One is, the manufacturing side of the economy has not really been what's driving U.S. growth over the last few years. It's not been what's driving global growth. It's really been about services sectors. It's mostly been in the U.S. about consumers spending on services. And so that has not been the engine driving the U.S. And I think if we see soft manufacturing activity going forward, that doesn't necessarily mean that the U.S. won't have another strong year. The second point, as you note, is the tariffs kind of have mixed effects in the sense that the long-term goal is obviously to bring back manufacturing production to the U.S. That would probably take a lot of time, even if it does occur. And at the same time, tariffs are likely to up costs for a lot of producers in the U.S. So it's a very complicated picture. And that's why overall, even if the tariffs have some long-run benefit, they do bring production back to the U.S. In the short run, we do think that the growth effects are particularly negative.
And so as we've been focusing in on the inflationary side, the other side of that, of course, for the Fed is the employment side, where both in the public sector and the private sector, where the private sector is not seeing attrition fast enough, at least in the case, I believe, of Morgan Stanley, then you could see more layoffs come forward versus in the public sector, everything's been focused around efficiency and what efficiency looks like as related to current headcount levels. How does that ultimately make a trend that the Fed then has to pay attention to? And could they be forced into a position where they need to take some policy action that we weren't even anticipating?
Yeah, absolutely. And the labor market is absolutely key to be watching here. And I think that one of the most important indicators that you highlighted is layoff activity. So far, layoff activity has remained relatively low. And that has continued even as you've seen a lot of this uncertainty playing through both on the public side and then what it means for the private sector. So we're watching all of that very closely. In particular, with the DOGE policies and efforts that we're seeing in Washington, is that having spillover effects to other parts of the region and into the private sector. And when you look at layoffs in the Virginia area, in the Maryland area, around kind of that DC ecosystem, you're not really seeing a substantial pickup in layoffs. So that's another thing we're watching closely in terms of risk. But right now, layoff activity remains relatively low on the private side. And you're even seeing on the public side some pushback against having that rapid adjustment, pushback against some of those DOGE efforts. Now, for the Fed, they're absolutely watching the labor market closely. And if you do see a sharp deterioration, you would likely start to see it in layoffs first. And then that as well could lead to those a more dovish stance that I was mentioning before, if you get substantial tariffs and a substantial fall in growth and substantial drop in business and consumer spending due to uncertainty. So I would be watching that layoff activity closely. Right now, not a whole lot to see there in the aggregate, still relatively low layoff activity.
Robert, good to have you with us as always. Thanks so much.
Thank you.
Coming up, Nike warning about the impact of tariffs. We've got the biggest takeaways from the company's results next on Morning Brief. Shares of Nike moving lower today as the company warns about the impact of tariffs, expecting sales to decline in the current quarter. This despite beating modest expectations for the third quarter. Yahoo Finance's Brooke DePalma joins me now with a closer look at Nike's exposure to China here. Brooke, we were breaking this down right after the close yesterday, right after the report dropped. We saw an initial pop on the report, but once the call got started, seems like investors and analysts started to price in a few more things.
Yeah, investors certainly spooked about that Q4 guidance that they said on the call. But let's kick off this conversation with really where their exposure is to China. If you take a closer look, based upon the company's annual reports, the amount of footwear that the company manufactures in China is down from back in 2016 when Trump initially took office, from 29% back then to 18% in their last year annual report. Now, apparel, also a significant decrease in just the amount of apparel that's manufactured in China. That number from 26% down to 16%. Now, despite this limited exposure, it was not enough to convince investors that they won't be hit by tariffs, and the company certainly warning of that on the call, that 20% of tariff on China, the 25% tariff on Mexico will impact their Q4 earnings. In the call, CFO Matthew Friend laying out, quote, "We are also navigating through several external factors that create uncertainty in the current operating environment, including geopolitical dynamics, new tariffs, volatile foreign exchange rates, and tax regulations, as well as the impact of this uncertainty and other macro factors on consumer confidence." All these headwinds up against the company, while Nike's also leaning into this turnaround strategy, what they're calling this win now strategy. It also expects the biggest impact from that to cause headwinds to Q4 revenue and gross margin. In Q4, the company expects to see revenue down in the mid-teens range, albeit at the low end. Fourth quarter gross margins also expected to be down approximately 400 to 500 basis points. Now, a big thing here is the CEO echoing on the call that these headwinds are expected to increase, or rather continue, into fiscal year 2026. All this certainly spooking investors this morning. Shares down now nearly 9% in early open.
All right, a lot to continue to track throughout the trading session and going forward during this quarter. Brooke, thanks so much. Nike CEO Elliott Hill says the company is making progress on its turnaround plan despite warning that sales will fall in the current quarter. Joining us now, we've got Simeon Siegel, BMO Capital Markets Managing Director. Simeon, good to see you here this morning. I just want to start with your biggest takeaways from Nike's latest earnings report.
So, listen, Brooke just went through, good to see you, by the way. Brooke just went through them all. They don't sound great, right? There's no question. You're looking at the market reflect a result last night that, to your earlier point, saw shares spike at the very beginning because the quarter was better than feared. And then as soon as we got guidance on the conference call, you watched everything else deteriorate. I think the quote that you pulled up a minute ago from Matt, from the CFO, was really important and interesting because what it spoke to was a host of uncertainty. There is a reason there's a new CEO in seat. We are in an uncertain time macro, but Nike has a very idiosyncratic uncertain time micro. What they need to do is create clarity. Nike needs hope right now. It doesn't need confusion. And I think right now what we're looking at is we're in process of a reset that we just are not sure when is going to end yet.
And so with that in mind, this word kept getting brought up in transition. And as much as the markets and investors hate to hear the word transitory because of our own PTSD with the word from the Fed, to hear it from one of the largest footwear and apparel manufacturers here in the US that has large tentacles in other parts of the world too, what does that hold for ultimately how they're able to kind of turn this ship around and what analysts and investors should be watching for within that massive effort?
Yeah, it's a really good point. But I do think, listen, there's companies and there's stocks. Nike, the stock, is clearly, the word transition might not be enough for what Nike, the stock, has felt. And so there is no question Nike, the stock, is in a slump. There's also no question that Nike, the company, is not doing what it used to do. And so I think juxtaposing, figuring out what that means, what's relative, what's sentiment, what's real, what's not. If Nike were to lose 20% of its business, it would be a $40 billion revenue business. It's still enormous. And so I think your point, though, is a very important point. There is a new CEO, which means somewhat by definition, the company felt like they needed to affect change. And so the question becomes like, that is literally a transition. And so you're right, it is this scary sounding word, but it's the reality. And so I think right now, as we look forward to Nike, the question is, can they just do it again, right? Can Nike say, we will introduce new product, we will use our industry-leading R&D budget, we'll use our industry-leading demand creation, marketing dollar budget, and we will tell the story to consumers like we've always had. If they do that, it's very hard to compete against because they have the largest check size, they have the largest budget, and they have that emotional connection to the consumer. Doesn't mean each quarter is going to be clean. I think the biggest question here, and like Starbucks, which I don't cover, is probably an interesting parallel where you're seeing big turnarounds. I think the biggest question here is Wall Street are we being handheld enough to say we understand it's bad, but we can see the light at the end of the tunnel? I think once that happens, that's when the hope kicks in. That's when people can say, I get that there are problems. I get you're guiding revenues down mid-teens. I get that margin is going to be pressured, but I see that Nike, this incredibly large business that's unparalleled in terms of its budget size and its revenue, is now giving me new launches. And that's what I think the story needs to be. I don't think we're there yet. I think that's what the market's reflecting today. But I think every individual quarter matters a little bit less than what the promise can be once you believe we've ripped that Band-Aid off.
I want to try and squeeze two more questions in one, and a lot of people are probably firing up the NKE ticker symbol on Yahoo Finance here today and taking a look at some of that historical data and probably coming across the fact that this company is now seeing its stock hit a level it hasn't seen in 5 years. That in mind, at this level, is Nike a buy?
I believe it's a buy. By the way, I think what's interesting is as of yesterday, it hadn't actually participated in the market decline. So your point, it took $5 to get us back 5 years, but with this last 2-week complete market collapse in my world, and generally speaking, Nike actually gave back only a month's worth. So now we're finally setting it back. That's actually, I think, more encouraging. I think the fact that we've gone back to this date is helpful. I think it's a buy, but I think you have to understand in this market, I'm not smart enough to call the bottom of anything. I mean, this, regardless of the companies, right? The market is doing what it's doing. You can have duration. If you can say, I believe this company, does this company have the wherewithal to come back? That I believe they certainly do.
And then just lastly, while we have you here, Simeon, because I know that over the years, you've heard the company talk about how much of the inventory they want to sell at full price. And now that strategy is certainly going to be tested, especially when you've got more of the wholesaler partnerships that are being reinvigorated as well. What is a fair evaluation, really, of how much of that inventory you're expecting to sell at full prices versus what's going to go into some of those wholesale and retail partners that then might need to be discounted just so that they can move through inventory, knowing their own purchase cycles?
I love that question. So that's actually the question I asked on the call last night, whereas like it sounds a little bit confusing right now, where on the one hand, they're working very hard to elevate what you and I see on their e-com, on their Nike.com website, is going to be more focused on full price selling. They want you and I to see their latest drops, and their latest launches are going to be quality brand lifting product. On the other hand, they have a lot of inventory. They have a lot of excess that they need to move. And so the factory outlets, different wholesale partners, are going to be used to clear through that product. I think the hardest thing that they have to figure out is making sure those two channels, those two consumers, don't converge. And that the people that are supposed to be seeing full price, or rather the product that's supposed to be saying, we're Nike, we're back, we're full price, is not diluted by the fact that drive out to an outlet and there's going to still be a lot on sale. And so I think that's going to be the delicate balance. I think figuring out effectively how do you run two separate companies is a very hard thing, a full price business and a clearance business right now. But the reality is what Nike has always been better at than everyone else is segmenting their product and telling those exact stories. Yeah. Nike, better than any other retailer or brand I've ever seen, can sell something. It can sell a limited shoe drop to the most exclusive collector, and then sell a back to school pair of regular shoes for $50 at a value channel. And that doesn't bleed them. That's what they need to do. They've always been able to do it. I think that's going to be the very delicate balance.
Simeon, great to see you. Thanks so much. Appreciate it.
Good to see you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, doing it in 30 seconds. Let's go. First up, Micron's margin outlook is overshadowing a positive second quarter earnings report. The chipmaker sees adjusted gross margin for the third quarter at the upper end of Wall Street's estimates. Plus, Johnson & Johnson will spend $55 billion in the U.S. over the next 4 years on manufacturing, research and development, and tech investments. That marks a 25% increase in investment compared to the previous 4 years. And finally, AstraZeneca will invest $2.5 billion in a new research center in Beijing in a show of confidence months after a top executive from the company was detained there by authorities. This is AstraZeneca's second strategic R&D center in China, and it will feature advanced early-stage research and clinical development enabled by an AI and data science lab. That does it for Morning Brief. More analysis next on Catalyst.